Hello everyone, in today's video we will be working through some computation problems from Chapter 3. So Chapter 3 was titled Working with Financial Statements. So what we were focused on was evaluating a company's balance sheet and income statement. We first talked about standardizing financial statements by creating what are called common size statements, where with a common size balance sheet you divide all values by total assets and then everything is listed as a percentage of total assets. And then we also did common size income statements where all items were divided by net sales, so then everything was listed as a percentage of net sales. And then we turned our discussion to ratio analysis. What we will be focusing on in today's video is solving for some ratio values where we are given some knowns, so we are given some inputs or we're given some values of other financial ratios, and we have to understand what is the relationship between different ratios and how can I take some given pieces of information to solve for some unknown. So what's important with this chapter is that with a ratio, it's simply one number divided by another number. That's not a difficult computation. So what our focus is here today is not to make sure that we understand how to take one number and divide it by another, rather that we understand what the components are of these different ratios and how they are intertwined. Okay, so keep that in mind as we go through. Just the first step is to always identify, okay, what is provided and how can I take what's provided to solve for some unknown, understanding the relationships between these different ratios and their equations. So starting off, it says a firm has sales of 15 million, total assets of 9 million, total debt of 3.7. Give us the profit margin of 7%, and then they ask for net income, and then ROA and ROE. So the first starting point is to identify what are we solving for. They want to know what is net income. Well, we know that net income comes from the income statement. It starts at sales and starts to take away all of the different expenses, and our bottom line is net income. Based on what's given, there's no way that we can construct an entire pro forma or projected, I guess, there's no way that we can construct an income statement based on what's provided. So let's look at the next ratio that they gave us, and it's profit margin. So we ask ourselves, what is profit margin? Well, the equation for profit margin is net income over sales. We see this net income part of the equation, and that's something that we're going to be asked to solve for. So then look at what else was given to us in the problem. They gave us sales, and they just told us what profit margin is. So they told us what profit margin is, they told us what sales are, and so the only piece missing then is net income. So we can very easily solve for net income by plugging in the profit margin and sales values that were given. So profit margin is 7%. We input that as a decimal. We are solving for the unknown net income. I plug in sales of 15 million. And then when I multiply both sides by 15 million, I end up getting a net income value that is equal to 1,050,000. So once again, we're solving for the bottom line on our income statement. We can't construct an entire income statement based on what's provided, so we first look at what ratio did they give us, what ratio value did they give us, what is the equation for that, and see if we can solve for some unknown. The second part of the equation then asks for ROA. So let's ask ourselves, what is the equation for ROA? It is net income over total assets. Well, what's nice about this is we just solved for net income and they gave us total assets. So we are given both of the pieces of information needed for ROA, so we simply insert into our equation, where this one is a little bit more straightforward, just one number divided by another. So I have a net income of 1,050,000 I just solved for, divided by the total asset base of 9 million, and I get an ROA that is equal to 0.1167, or this ROA is typically listed as a percentage, so it's 11.67%. So you can think of this as they are generating a 11.67% return in profit on their asset investment, on what they have as their total assets currently on the books. Again, this is an accounting value, it's a book value, and we know the assets are depreciated, but it does give us an idea as to what type of profitability is their asset base generating. Last up is ROE, so they are looking for ROE. We look at ROE and see that that the equation for ROE is net income over total equity. Now, before we even start this problem, we see that they do have total debt of 3.7 million. As discussed in the lecture video, anytime a company has any type of debt, their ROE is going to be more than their ROA. So we know that this ROE is going to be greater than 11.67% because they're utilizing debt in their capital structure. But going back to our what's being asked here, they're asking us for ROE. We've already solved for the net income portion there. And now we ask ourselves, what is total equity? We know equity is found on the right-hand side of our balance sheet, and we also know that total assets equals total liabilities plus total stockholders' equity. And they have given us total assets, and they have given us total liabilities or total debt. So I will have to subtract total liabilities from total assets to get total equity. So what we have here is we had to work around and understand our balance sheet identity up here in order to solve for that unknown, which was total equity. Net income was the $1,050,000 from before. And then total equity is going to be the difference between total assets minus total liabilities. And once again, that is your balance sheet identity. So when I go ahead and divide these, I get a value of 0.1981, or just like ROA, it's more often listed as a percentage. So you get 19.81%. So their equity investment is generating a 19.81% in terms of net income. Again, greater than ROA, just like we thought it was going to be, since they did utilize debt in their capital structure. But that is a type of problem that you can expect to see where you're given some pieces of information you have to work around to solve for some unknown. Moving forward, we'll take a look at number 2. Bobaflex Corporation has ending inventory of $426,163. Cost of goods sold for the year just ended was $6,238,615. What is the inventory turnover? What is the day sales in inventory? How long on average did a unit of inventory sit on the shelf before it was sold? So, first thing we need to look at or understand is, what is inventory turnover? Well, inventory turnover essentially tells you how many times did you sell and replenish your inventory balance over the course of the year. So how many times did you turn over your inventory over the course of that year? So it takes an income statement item, your cost of goods sold, and it divides it by, it takes your income statement item, your cost of goods sold, and divides it by your balance sheet item, the balance of whatever your inventory account is. So it's equation cost of goods sold divided by inventory. And in this scenario, they have actually given us both of those pieces of information. Cost of goods sold was $6 million plus. Inventory is $426. So how many times did they sell through an inventory amount similar to the $426,000 that they currently have on the books? How many times did they sell through that and then replenish it over the course of that year? So once again, let's just go ahead and divide these two. Cost of goods sold is $6,238,615. Divided by ending inventory of $426,163, and I end up getting an inventory turnover of 14.6390. This is 14.5 times that they have gone through an inventory amount similar to the 426 that they currently have on their balance sheet, their ending inventory on their balance sheet. They sold through that 426,000 and replenished it 14.5 times over the course of the year. Now, how long did it take them to go through an inventory equal to that amount or similar to that 426,000? That's when we calculate days sales in inventory. Days sales in inventory takes 365 days, and we divide it by the inventory turnover. So what we get here is 365 divided by 14.6390, and we end up getting a day sales in inventory of 24.9334, or approximately every 25 days they were selling through their inventory. So then the last part of the question then is, how long on average did a unit of inventory sit on the shelf before it sold? Approximately 25 days. So remember that the inventory turnover is an income statement item divided by a balance sheet item, and we know that the income statement tells a story over a period of time, whereas the balance sheet is a snapshot and a point in time. So when the balance sheet was created, this is what their inventory balance was, and we're taking a story and saying that we sold through that 426,000 and then replenished it a total of 14.5 times over the course of that year. And if that was the case, then it was taking us approximately 25 days to go through our inventory, or 25 days to sell through the inventory that was sitting on the shelf. Okay, continuing on, number 3. A firm's profit margin is 10%, net income $400,000, total assets are $550. Find the total asset turnover for this firm. So total asset turnover, we remember, is an asset efficiency ratio. And the equation for total asset turnover is sales divided by total assets. So is our investment in assets translating into sales? We can see that we are given total assets, so we're given the bottom part, but how can I get sales? They don't give me sales. However, they do give me profit margin and net income. So let's go ahead and write out what is profit margin. The profit margin equation is net income divided by sales. Once again, they gave us profit margin and they gave us net income. I can solve for that unknown sales, which is the last piece needed in order to utilize the total asset turnover equation. So profit margin is 10%. Net income is $400,000, and we are solving for sales. So multiply both sides by sales and then divide both sides by 0.1, and we end up getting a sales figure that is equal to $4 million. So they would start off with $4 million in sales, and their bottom line after all expenses was retaining 10%. So net income of $400,000. That is our last piece needed here in order to now solve for total asset turnover. So I input that in for sales, $4 million for sales, divided by total assets of $550,000, and I end up getting a total asset turnover that is equal to 7.27. What does that mean? For every dollar they're investing in assets, they're generating $7.27 in sales. Once again, we're combining assets, a balance sheet item, your assets, and an income statement item, your sales. So this is simply what their balance is on their assets on their balance sheet. It could be a little misleading if their assets are fully depreciated or if they just purchased new assets. It could be misleading. It would just require additional insight if this was a drastic fluctuation from previous years or a drastic difference from their main competitors. But what's important to understand is that this value right here is kind of showcasing that we are generating $7. Our investment in assets is translating into $7.27 in sales. So once again, ratio values by themselves don't tell a whole lot. What they can do, though, is they can identify areas of efficiency or inefficiency and at least provide insight as to what areas of a business you might have to do further research if you notice drastic changes or drastic differences in their ratio values in comparison to their main competitors. Number 4, a firm has total assets of $8.5 million, total asset turnover of 1.8, ROA is 8.5%. What is profit margin? Well, we know that profit margin equation is net income over sales. I look at the information that's provided. They have not given me any of that. So let's look at the ratios that they provided. They gave us an ROA. ROA's equation is net income over total assets. What's nice and what you kind of start to see is they gave us ROA, they gave us total assets, and so I can solve for this unknown net income, which is going to be my top item in my profit margin equation. So as I go through here and I plug in the ROA that's provided, I plug it in as a decimal, 0.085 is equal to net income is what I'm solving for, divided by total assets of 8.5 million. Multiply both sides by 8.5 million, I get a net income value that is equal to 722,500. So I'm halfway there. Go ahead and highlight this. This is my halfway portion of my profit margin. As you can probably imagine, let's take a look at what is the other piece or the other ratio value that was given, which is total asset turnover, and let's write out what its equation is. Total asset turnover is equal to sales divided by total assets. We can see here that we need sales in our profit margin. This equation has sales, and if you start to highlight what was given, they gave us total asset turnover, and they also gave us that total assets from before. So I can very easily solve for, so they gave us total assets or total asset turnover, and they gave us total assets. We can now solve for sales. So total asset turnover was 1.8. This is not a percentage, so we don't convert this to a decimal when we input it into our equation. We are solving for sales. Total assets are 8.5 million. Multiply both sides by 8.5 million, and I get a sales value that is equal to 15,300,000. So once again, kind of highlight here to showcase that we have just solved for sales. That is our bottom line there in our profit margin. So step 3 is to take this information from our profit margin equation that says that profit margin is equal to net income. I'll just write the equation again. Over sales. Net income is what we solved for first, 722,500 divided by sales, 15,300,000. And so the profit margin here is 0.0472, or again, most frequently listed as a percentage, so 4.72%. So of every dollar this company sells or generates in terms of sales, they have 4.72% remaining in the form of net income after all expenses have been deducted, or expensed, I should say. All right, number 5, based on the following information, what is the return on equity? Our equation for ROE is equal to net income divided by total equity. And so we have to ask ourselves, are we given any of this? We have profit margin and sales, so those are 2 income statement items. Assets and liabilities, those are balance sheet items. So let's kind of process how we can go through with all this. Net income, we know, is on our income statement. If they give us profit margin and sales, let's think to ourselves, what is the equation for profit margin? It is net income over sales. And so hopefully you're already starting to see where this is going. They gave us the profit margin, they gave us sales. We can very easily solve for the net income. So profit margin is 7%. I convert it to a decimal when I input it into my equation. I'm solving for net income, and my sales value is provided at 12 million. When I solve for net income, I get a value that is equal to 840,000. So this is simply the top line in my net income, or in my return on equity equation. Now we have to figure out, how can I solve for total equity? They have given us assets and liabilities. So this is where you must remember the balance sheet identity that says that total assets equals total liabilities plus total stockholders' equity. They gave me assets, they gave me liabilities. I can very easily solve for the amount of equity since it must always balance. So total assets is 6 million. Total liabilities is 1.8 million. I can solve for total equity. When I solve for total equity, I get a total equity value that is equal to 4,200,000. And so now what I've done is I've just solved for the bottom part of my return on equity equation. I can just insert the net income and total equity values that I just solved for and solve for the return on equity. So net income was 840,000. Total equity was the 4.2 million that we just calculated, and I end up getting a return on equity value that is equal to 0.20, or as I mentioned, simply referred to, or oftentimes referenced as a percentage, so 20%. So on their equity investment, they are generating a 20% return in the form of net income. Number 6. This one's a little bit less straightforward than some of the other ones. So how many dollars worth of sales are generated from every $1 in total assets if a firm has net working capital of 600, net fixed assets of 3,450, sales of 6,500, and current liabilities of 1,200? So I mentioned that this is not as straightforward as the other problems that we've completed thus far. The first thing that we need to identify is, what are they asking for? So how many dollars worth of sales are generated from every $1 in total assets? So you have to ask yourself, which category of ratios focus on assets translating into sales? So if you think back to the lecture, to the first part of the Chapter 3 lecture, we had 5 different categories of ratios. Category 3, your asset efficiency or your asset turnover ratios, are the ones that focus on assets translating into sales. So which of those ratios within the asset efficiency ratio group deal with total assets converting to sales? Hopefully, as you look through your equation sheet, you can see that that is total asset turnover. So your equation for total asset turnover is what amount of sales are generated per dollar of assets. So the higher this value, the more technically the more efficient you are utilizing your assets to translate into sales. But that is what this equation, or that's what this problem is asking. They're not explicitly asking what is the total asset turnover. They're more so assessing, do you understand what total asset turnover actually is? And do you know that that is the ratio that compares the amount of sales generated per dollar of assets? So now what we need to do is figure out, all right, I know what I'm solving for. How do I get the pieces of information that are needed? Well, we just look through what's given. Sales are something that we need. They tell us that sales are 6,500. So no difficulty there. However, how can I get total assets? This is where you have to think to your balance sheet. Total assets are equal to total liabilities plus total stockholders' equity. That piece of information does not help us because we do not have any of the right-hand side of the balance sheet information. But we also know that our total assets can be broken down into current assets and fixed. So we know, based on what's given, that fixed assets are $34.50. So let me just kind of showcase what I'm doing here. On the left-hand side of our balance sheet, we know that assets are either current or fixed. They just gave me the fixed value of $34.50. So how can I take what's provided to solve for the current assets? Well, they give us this thing called net working capital. If you think back to chapter 2, what is net working capital? Remember, working capital is your day-to-day stuff. So what is your total working capital? Your net working capital is simply current assets minus current liabilities. So they have given us this net working capital value, and they also gave us the current liabilities. So I can solve for the current assets, which would then give me my two types of assets, current and fixed, and I can add those together to get my total assets, which are needed for the total asset turnover. So net working capital is 600 given. Current assets is what I'm solving for. Current liabilities is 1,200. Add 1,200 to both sides, and I get current assets equal to $1,800. Now, that's not the final value. What this is only giving us then, we have current. They have given us fixed. And we need to add those two together to get total assets. So total assets is current assets plus fixed. Current assets are 1,800. Fixed assets were given at 3,450. I add those two together and I have total assets then of 5,250. So I have my second part of my equation. My last step then is to just insert into my total asset turnover equation. Sales were given in the problem as 6,500. Total assets is what we just solved for, 5,250. When I solve for total asset turnover, I get 1.24. So you can think of this as for every dollar they are investing in assets, those assets are generating $1.24 in sales. So once again, does require further analysis if this is a substantial change from previous years or substantially different from their competitors. Maybe their asset investment is fully depreciated or their asset base is fully depreciated, or maybe they just made a large investment in total assets and it decreased their total asset turnover. But this gives you an idea as to how efficiently they're utilizing their investment in assets to translate into sales. 7 is more of a conceptual type problem, just understanding what an impact on one change in values will have on financial ratios. And so what will happen to profit margin, ROA, total asset turnover, and ROE if cost of goods sold decreases? Where is cost of goods sold located? Cost of goods sold is on your income statement. So we have sales, and we expense cost of goods sold before we get down into our operating income. Now, we have other expenses before we get into operating income, such as SG&A and depreciation all being deducted. But we can see that sales is one of the earlier expenses on our income statement. So if we have a decrease in our cost of goods sold, what's going to happen to your profit margin? Well, profit margin is equal to net income over sales. Sales is unaffected because cost of goods sold comes out after your sales your sales item. Net income is the bottom line. So if we've actually decreased this expense, what's going to happen to your net income? Your net income is going to go up because you have a smaller expense before you got to your bottom line. So your profit margin is actually going to go up because your net income's going up because you better handled or better managed one of your expenses. Your cost of goods sold have actually gone down. Looking at ROA. ROA is equal to net income over total assets. Once again, we just talked about net income going up. Total assets is on your balance sheets unaffected by a change in your cost of goods sold, so your ROA is also going to go up. Total asset turnover. Total asset turnover is sales over total assets. Sales top line figure over here on our income statement before cost of goods sold, so this is going to be unaffected. Total assets is also going to be unaffected. So what's going to happen? Most likely nothing. Nothing's going to happen to total asset turnover because we decrease one of our expenses after sales. So our sales figure is unaffected, same with our total assets. And then last up would be ROE. Similar to ROA, it has net income in the numerator. We know that if we decrease one of our expenses, our profit, our net income goes up. Total equity is unaffected. So overall, ROE would also go up. So basically what we see here is if we are able to decrease one of our expenses, profit margin, ROA, and ROE would all also increase. Total asset turnover would have no impact. There would be no impact on total asset turnover. So that's why it's important to be able to manage your expenses and generate a higher net income, is that it does influence and impact all of these ratios that are used. That's not one of the reasons, but to understand that if a company is able to decrease one of their expenses, keeping everything else relatively the same, it is going to positively reflect on these different ratios. Number 8, the Cavo company has a ROA of 9%, a profit margin of 6%, and an ROE of 17%. And what is the company's total asset turnover? And what is the equity multiplier? So this one's also, now we're starting to get into some more complex problems. If I look at number 8 and they're asking for total asset turnover, I know from previous problems that total asset turnover is sales over total assets. And they don't give me any values. They give me ROA, which is net income over total assets. They give me profit margin, which is net income over sales. And they give me ROE, which is net income over total equity. How can I take any of this information? I would think that I could start with profit margin, net income over sales, and somehow find sales. But I don't have any of the other information to solve for net income to get sales. So this is where we have to remember the DuPont. So towards the end of our discussion on part 1 of chapter 3's lecture video, I talked about the DuPont identity, and the DuPont identity really had 3 steps. The first step is that they took your return on equity equation and were able to break it down into a component of a company's ROA and their equity multiplier. Step 2 then, so that was step 1, taking your ROE and breaking it down to ROA times equity multiplier. Step 2 was doing a similar type of construction. I'm not going through all that now. You have to look at the lecture to get a review of that. Step 2 was to take ROA and break it down into a product of profit margin and total asset turnover. So this was step 2 of the DuPont. And then step 3 of the DuPont was to just take your final and plug in the parts from part 1. So ROE is equal to profit margin times total asset turnover times the equity multiplier. So these are the 3 steps of the DuPont. And based on what's given here, so step 1 was breaking down ROE and equity multiplier. Step 2, tried to highlight that there, circle it, ROA broken down to profit margin and total asset turnover. Step 3 is just plug in the full DuPont identity. Here they want to know what is the company's total asset turnover. Well, they have given us ROA, and they have also given us profit margin. And so hopefully as you're looking there inside of step 2, I can solve for total asset turnover using this second breakdown of the DuPont. So this is a partial DuPont question where ROA is equal to profit margin times total asset turnover. ROA is 9%, so insert as a decimal, 0.09. Profit margin is 6%, insert as a decimal, 0.06, multiplied by total asset turnover, what we're solving for. And so then when I divide both sides by 0.06 and solve for total asset turnover, I get a total asset turnover equal to 1.5. So for every dollar they're investing in assets, they're generating $1.50 in sales. And then the last part of the question says, what is the equity multiplier? Once again, I'm not really given any information to solve for the equity multiplier in terms of it's an actual equation, which is total assets divided by total equity. However, based on this DuPont stuff here, I have ROA, I have ROE, and I can solve, I have ROA, I have ROE, and so I can solve for the equity multiplier using step 1 of the DuPont. So ROE is equal to ROA times the equity multiplier. They have given me ROE of 17%. They gave me ROA of 9%. I'm solving for the equity multiplier. Divide both sides by 0.09, and I get an equity multiplier value of 1.89. So they have $1.89 in assets per dollar of equity. The higher that value is, the more leveraged the company is. But what's important that we understand here, and I could do stars and all kinds of stuff around here, is that we understand the different components of the DuPont. Okay, we're going to be doing a lot more problems with the DuPont identity here as we progress through the rest of these practice problems. But it is very important that we understand that the DuPont is focused on maximizing ROE. The first step is breaking down the ROE to a component or to a product of ROA times the equity multiplier. Step 2 then was to take ROA and break it down in a similar fashion into the product of profit margin and total asset turnover. And then the full DuPont identity says that the return on equity for a company can be broken down into a component of profit margin, your expense management, total asset turnover, your asset management, and your equity multiplier, which is debt management. All right, continuing on. Question 9. A firm has net working capital of $420, net fixed assets of $2,166, sales of $5,300, current liabilities of $730. How many dollar worth of sales are generated from every $1 in assets? So if you've never seen a problem like this before, you're like, okay, what are they even asking for? How many dollar worth of sales are generated from every $1 in assets? Well, if you just took it verbatim and said how many dollars worth of sales are divided for every $1 in total assets, you just have sales over total assets. Hopefully you already know that we have a ratio that is sales over total assets, and it is simply the total asset turnover ratio. So with our total asset turnover, trying to figure out how do I get sales, how do I get total assets. As I work through this problem, I can see that I have sales given to me of $5,300. How can I solve for total assets? This is very similar to the previous problem where we were dealing with total asset turnover. That would have been question 6. So very similar setup here where they gave us net working capital. Net working capital here is $420. We know that total assets on the left-hand side of our balance sheet is equal to current and fixed. They have given us fixed assets of $2,166, and then we know that net working capital is equal to current assets minus current liabilities. If you need a refresher, rewind this video to look at the equation for, or the solution for question 6, as it is very similar in structure. Net working capital then is $420. That was given to us. Current assets is what we are solving for. They gave us current liabilities of $730. So I add $730 to both sides and I get current assets equal to $1,150. They have given us a fixed asset amount of $2,166. Add that to the current assets of $1,150. So total assets equal current plus fixed. And so I get total assets equal to $3,316. And so my total asset turnover, finally, that would be this bottom part of my equation. I was given sales initially, so I just take the sales that were given in the problem of $5,300 divided by total assets of $3,316, and I get a total asset turnover of 1.60. So for every dollar they're investing in assets, they're generating $1.60 in sales. As I mentioned, very similar to the previous problem. And then question 10, a firm has an equity multiplier of 1.5. This means that the firm has a total debt ratio of what? Well, this is kind of confusing. So they give us a equity multiplier ratio, we know that equity multiplier is equal to assets over equity. And then they're asking us for a total debt ratio, which is debt divided by assets. So what percentage of our assets are funded by debt? But they've only given us one value. How am I supposed to solve for some unknown if I only have one value? This is where you must remember that when we covered our 5 categories of ratios, one of the categories were called leverage ratios. And leverage ratios were broken down into debt ratios, which quantified the amount of debt, and also coverage ratios, which covered the ability of the companies to actually meet those debt obligations. But part 1, the quantifying ratios, we had 3 different debt ratios. We had the total debt ratio, the debt to equity ratio, and the equity multiplier. All 3 of these are all 3 of these are debt ratios, and they're all simply showcasing how much debt a company uses in their capital structure, but they're showcasing it in a different means. One is debt relative to total assets, one is debt relative to equity, and the other one then is debt relative or assets relative to equity. But all of these are balance sheet items, and since the balance sheet must always balance, what's nice about these debt ratios is that once you know one of the debt ratios, it's there's relationship equations that allow you to solve for the other 3, or for the other 2. What's important to realize here is that you pick up on equity multiplier is a debt ratio, so is total debt ratio. So now I know that I can use one of my equations to solve for the unknown. What are the equations that I'm referencing? The first equation, or the debt relationship, says that the equity multiplier is equal to 1 plus your debt to equity ratio. Well, that doesn't help us in terms of finding the total debt ratio, but the total debt ratio also has a relationship that says your debt to equity, it's your total debt ratio is equal to your debt to equity divided by 1 plus your debt to equity. So what I can do is do step 1, where they gave me the equity multiplier here of 1.5, and solve for your debt to equity. And then once I solve for that debt to equity, I can use this second equation to solve for the total debt ratio. So let's do step 1 over here. The equity multiplier was 1.5 is equal to 1 plus your debt to equity. So hopefully you can see that your debt to equity ratio would just be equal to 0.5. And so then step 2 would be to utilize this relationship down here, which says that your total debt ratio is equal to debt to equity 0.5 divided by 1 plus 0.5. So what I get is 0.5 divided by 1.5, which is equal to 0.33, or 33.33%. So their total debt ratio is equal to 33.33%. So they are funding their assets with 33% debt, which would mean that 67% of their assets are funded with equity. That is their capital structure, their breakdown of debt versus equity. What's important here is to understand that we know that there's 3 debt ratios: a total debt ratio, a debt to equity ratio, and an equity multiplier. All 3 quantify the amount of debt in a capital structure, and they just showcase it in a different format, but they're all using balance sheet totals. So it's either debt relative to assets, debt relative to equity, or assets relative to equity, but they all are different means of showcasing the amount of leverage that a company is using. And we need to understand that once I know one of those 3, I can use these relationship equations to solve for either of the other 2. Okay, so this next group of problems, they aren't quite as explicit in what they are asking for as some of the previous problems that we've completed. So it is going to be important to really read the question details carefully and try to understand exactly what ratio would measure what the question is asking. Okay, so in question 11, which of the following utilize its assets, and you can see it's bolded, utilize its assets most efficiently to generate revenue? So this is assets translating into revenue or sales. And look at what the items that are provided. Net profit margin. Net profit margin is equal to net income over sales. So is that something that is dealing with assets translating into sales? No, it's just simply this is just simply what percentage of your sales remain in the form of net income at the end. It has no correlation between sales, or it has no information on asset investment translating into sales. Most people would say, oh, it's the one with the highest ROA. However, ROA is equal to net income over assets, total assets. Is net income and revenue the same thing? No. So this is taking an asset base and translating it into profit, net income, and then return on equity, similar, net income over total equity, except that one doesn't even deal with assets. So which equation or which ratio focuses on assets translating into revenue? Hopefully, after we've done a few of these previous problems, you realize that that is the total asset turnover equation. The total asset turnover equation is equal to sales divided by total assets. So for every dollar invested in assets, what is it translating into in terms of sales or revenue? But based on what's provided, we don't have access to sales or total assets. However, if you were to go back up to question 8 here in particular, the different parts of the DuPont, and I see that total asset turnover there in step 2 and step 3. In particular, looking at step 2, we can see that ROA is equal to profit margin times total asset turnover. So utilizing the DuPont that says ROA can be broken down into profit margin times total asset turnover, we can see that total asset turnover can be broken down into, if I isolate total asset turnover, it would be equal to ROA divided by profit margin. So this is simply utilizing the DuPont and the partial DuPont to understand that if I take this ROA and divide it by profit margin, I will get a total asset turnover based on the given information. So I'm just going to start off with the first two, and you guys can verify the rest of this because it's the same thing over and over again. What we would be doing is taking ROA and dividing it by profit margin. In part A, 16% divided by 10% would give me a total asset turnover of 1.6. If I were to do 15% divided by 9%, I'd get 1.667. Part C, I would get 1.75. In part D, I would get 1.8, 1.8, I think it's 1.86. And part E would be 1.8. Let me just verify that last one of 0.17 divided by 0.09 will give you 0.11 or 0.188 or 1.89. And so which of these companies utilize its assets most efficiently to generate revenue? It would be the highest total asset turnover. So in this case, it would be company D. So as I mentioned, this is not as explicit as some of the other problems that we've done thus far, but the key here is to understand, first of all, one, what ratio actually measures assets translating into revenue. In this case, it was total asset turnover. And so how can I solve for total asset turnover given the information that was provided? Question 12, which of the following is most financially leveraged? You have to ask yourself, what does leverage mean? Well, leverage deals with the amount of debt in your capital structure. So how much debt are you using to fund your assets? Going back to our debt ratios, we know that we have the total debt ratio, the debt to equity ratio, and the equity multiplier. Here in this problem, they give me profit margin, ROA, and ROE. None of those deal with debt. None of those are a component or part of our leverage categories of ratios, but hopefully you can kind of catch on here. Where have I seen profit margin, ROA, ROE in relation to an equity multiplier or to a debt ratio? It's in the DuPont. So once again, I'm just going to restate my breakdown of what the DuPont is. Step 1 was to take ROE and break it down into ROA times the equity multiplier. Then we took ROA and broke it down into profit margin. Clear this up a little bit. Broke ROA down into profit margin times total asset turnover. And then step 3 was to put it all together. In this case, I need to solve for, we know that which of the following, or they're asking for a measure of leverage. And we don't have any information for total debt or debt to equity ratios, but I can solve for the equity multiplier by using one of these DuPont steps. Either step 1, step 2, or step 3. Based on what's given, I have ROA and ROE. I can solve for the equity multiplier using step 1. So going over here to the left, where step 1 is ROE equals ROA times the equity multiplier, Isolating the equity multiplier would be equal to ROE divided by ROA. So what I'm going to do is take this ROE and divide it by ROA and solve for the equity multiplier. Equity multiplier for part A is 2.31, for part B is 2.4, in part C it's 2.29, in part D it is 2.29 also, and in part E it is 2.11. So I have these different equity multipliers. Now you have to ask yourself, are you more or less financially leveraged the higher your equity multiplier is? Well, the equity multiplier, its equation is assets over equity, so the greater the distance between those two, that means more debt is being utilized. So the higher the equity multiplier, the higher the leverage, the higher the amount of debt. So which one has the highest equity multiplier? It is selection D. Sorry, selection B. 2.4, the highest equity multiplier. 13. Which of the following would most likely offer a company the highest return on assets? Your ROA equation is equal to net income over total assets. We're not given net income, we're not given assets, we're giving no actual income or balance sheet items, but we are given other ratios. Hopefully you kind of see that when I have net profit margin, inventory turnover, total asset turnover, that I'm starting to see a relationship here. I'm starting to see you catch on to the trend. I'm looking for an ROA, and except for inventory turnover, profit margin and total asset turnover are seen over here in part of our DuPont. So I should be able to solve for ROA using some part of the DuPont. So if I look at step 2 over here, that says ROA is equal to profit margin times total asset turnover, I am solving for ROA, and they have given me profit margin, and they have given me total asset turnover. So what I'm going to do is multiply those two together, and remember that profit margin should be input as a decimal, so 0.12 times 1.5 will give me an ROA for part A of 0.18 or 18%. For part B, it would be 0.1 times 2, and I would get an ROA of 0.2 then, or 20%. Do the same for part C, I get 12%. D, I get 15%, and E, I get 8%. Which of the following would most likely offer a company the highest ROA? It would be B once again in this scenario. So as you're going through your homework and the future exam questions, if you ever catch a roadblock and you see anything that deals with ROE, ROA, profit margin, total asset turnover, or equity multiplier, any of the components of your DuPont, be sure to consider that as a possible source. So these questions here are really assessing, do you understand the different components of the DuPont identity? And the more practice you can do with understanding the relationships and how you can use some information to solve for unknowns, the more the more quickly you'll be able to move through these problems. It's important that you understand what the different components are of the DuPont identity. 14. Which of the following would most likely offer a shareholder the highest return on equity? ROE is equal to net income over total equity, but it's also looking at that DuPont identity again, equal to profit margin times total asset turnover times the equity multiplier. What we have here is, I'll just rewrite that so we have it on the same page. They have actually given us all three of those inputs, so what we would do is just multiply straight across. Be sure, though, that when you input profit margin, you input it as a decimal. So for part A, I have 0.12 times 1.5 times 1.5. I would have a ROE that is equal to 0.27. For part B, it would be 0.1 times 2 times 1.5. I get an ROE of 0.3 or 30%. Part C is 0.24 or 24%. 0.375 for D, 37.5%. 0.16 for E, 16%. So which one offers the highest ROE? It would be D at 37.5%. 15. Which of the following companies has the highest dividend payout ratio? Well, we know that a company has two options with their net income. They either pay it out in the form of dividends or they add it to retained earnings. They have an addition to retained earnings. So the dividend payout ratio is dividends divided by net income, and it gives you a percentage of your net income that's paid out to dividends, and then your retention ratio is the amount that you retain in the form of retained earnings, which is retained earnings divided by net income. So in this case, which one would have the highest dividend payout ratio? It would be the one with the lowest retention ratio. So for example, we know that the retention ratio and the dividend payout ratio have to add up to 100%. So for Part A, if they're retaining 30%, that means they're paying out 70. Part B, if they're retaining 60, they're paying out 40. Part C, they're retaining 60, or they're paying out 60. Part D, they're paying out 80 if they're keeping 20. And then 50-50 for Part D, or for Part E, sorry. So which one has the highest dividend payout ratio? It would be D at 80%. Okay, so the lowest retention ratio would mean the highest dividend payout ratio. And then last up would be 16. Assuming the following sets of ratios belong to competitors in the same industry, which of them appears to have the highest perceived future growth rate? Which of our ratios deals with perception of future prospects? That is straightforward. That is your price to earnings ratio, the amount that you're willing to pay per dollar of earnings for the share, or for the per dollar of earnings per share. And so it's the one with the highest PE ratio. So in this case, it would be D. You'd be willing to pay $20 per dollar of earnings per share if you were to purchase that share of stock at whatever its current stock price is. So those are some computation practice problems for Chapter 3. The only type of problem that we really didn't deal with on here deals with common size values. Just remember that a common size balance sheet has all items divided by total assets, so everything's listed as a percentage of total assets. And then a common size income statement has everything divided by sales. So everything is divided by your sales figure and listed as some percentage of sales. But hopefully this will help you out with your Chapter 3 homework and your exam questions here coming up. If you have any questions, don't hesitate to reach out. And good luck. I'll talk to you all soon.